Okay, let's start our webinar on time. Good afternoon. Welcome to today's webinar, Hedging Strategies for Crude Palm Oil through Futures and Options. This webinar is presented by Straits Financial and Bursa Malaysia Derivatives. I'm Meng Na, and I'll be your moderator today. Okay, first disclaimer of this event. Trading in futures entails significant risks, and presentations in this event should not be considered as trading recommendations. The rest is for you to skim through. Okay, so a brief introduction of Straits Financial to the audience who are new to the channel. Straits Financial Group is a financial brokerage house that provides access to commodities, exchange-traded OTC, Forex, and the financial derivatives market for all your trading needs. You are supported by an experienced dealing team 24/5 based out from Singapore and inter-dealer brokerage services for trade execution. We also offer OTC structured products to meet the unique and sophisticated requirements of each client. Headquartered in Singapore, we have a strong presence and understanding of the Asian markets, and with offices in the United States, China, Indonesia, and Dubai, we bring forth access to global markets. Please contact us by the information provided here if you have any queries. Okay, so our webinar today is about hedging strategies for crude palm oil through futures and options. Here is the agenda. We will hear three industry experts and specialists share their perspectives on crude palm oil market, product updates, and introduction from Bursa Malaysia Derivatives, the most traded exchange for CPO, and also examples of hedging strategies using CPO futures and options. At the end of the webinar, there will be a Q&A session. Now, please allow me to introduce our guests today. First, let's welcome our guest from Bursa Malaysia, Nicholas Lau. Hi, Nicholas. Can't see you now, but later you can see him. Thank you very much for joining us. Nicholas joined Bursa Malaysia Derivatives in 2019 and is currently part of the commodity derivatives team in the product and market development department. He is tasked with developing and expanding Bursa Malaysia Derivatives' suite of commodity products in order to meet the market needs of the industry. Prior to joining Bursa Malaysia Derivatives, Nicholas graduated from the University of Bristol in 2017 with a bachelor's degree in law and was called to the Bar of England and Wales in 2018. Welcome, Nicholas, for joining us today. Today, we will also have two in-house speakers from Financial, Patrick and Zach. Patrick Yeo is the sales director and account manager at Straits Financial Group. Hi, Patrick. Thank you for joining us today. Patrick has more than 35 years of experience in the global derivatives market, specializes in futures, options, and commodities. He started his career as a gold and silver trader in 1981. Prior to joining Straits Financial in 2016, he worked for the Singapore Exchange for 9 years as a director for commodities markets, in charge of the rubber market at SGX. Mr. Yeo has also held senior positions in his previous companies, which include Man Financial, Revco Singapore, and On First Private Limited. Thank you, Patrick, for joining us today. Our next speaker is Zach, regional manager at Straits Financial Group. Hi, Zach. Welcome. Zach has over 5 years of experience in the Chinese market and now is our regional manager covering China and also part of our Asian structured products team. Prior to joining Straits Financial, Zach has led teams within asset management and commodity trade financing sectors, covering both China and Singapore markets. Thank you all for joining us today. Now, without further ado, let's welcome our first speaker, Nicholas, to give us a talk on the introduction to Bursa Malaysia derivatives, its palm complex offerings, and upcoming East Malaysia CPO futures contract. Okay. Nicholas, can you share screen?
Yep, thanks, Magna.
Thank you.
Give me a minute. Okay, great. A really good afternoon to everyone. It's really nice to be a part of this webinar. So big thank you to Straits Financial for letting me participate as a speaker in this webinar today. So my name is Nicholas Lau. As Magna has already introduced, I'm part of the commodity derivatives team in Bursa Malaysia Derivatives. So in today's presentation in this webinar, I'll be giving you a brief background of BMD and Bursa Malaysia, and then talk a bit about our flagship palm oil complex, and then give a bit more snapshot and highlights of the very, very exciting upcoming contract, which is the East Malaysia Crude Palm Oil Futures contract. Okay, so without further ado, so this is the governance structure of Bursa Malaysia Berhad. And so as you can see here, BMD or Bursa Malaysia Derivatives, we are regulated by the Securities Commission. So the SC administers and enforces law, is in charge of licensing of our brokers as well as issuing guiding principles. And then Bursa Malaysia Derivatives is a wholly owned subsidiary of Bursa Malaysia Berhad. And so BMD as an exchange, we administer and enforce rules. We perform frontline surveillance as well as frontline supervision of our brokers. And of course, we have our clearinghouse, which is a wholly owned subsidiary of BMD. So our palm complex product offering. So BMD offers the most liquid and successful crude palm oil futures contract in the world, or FCPO for short. So the FCPO is our flagship star product is in our palm complex product offerings. So as you can see here, we have a few palm related products, namely the FCPO, the RBD palm oil futures or FPOL, the crude palm kernel oil futures, FPKO, the US dollar crude palm oil futures, FUPO, the options on crude palm oil futures, OCPO, and of course the USD RBD palm oil options. So just a bit on our FCPO, as many of you already know, our FCPO is our most successful palm oil product in BMD, and also it is the most liquid and successful crude palm oil contract in the world. So this actually consolidates Malaysia's position as the global center for palm oil price discovery. And at the same time, our FCPO provides a very fair and transparent avenue for global investors to trade and manage their risks to pricing and volatility. So our FCPO has been performing really well. Over the past year, last year in 2020, our FCPO actually broke quite a number of trading records in terms of daily volume as well as monthly volume, and of course, annual volume. And this year, BMD actually managed to sustain this momentum for FCPO, and we actually witnessed FCPO breaking its record in terms of monthly volume, where in June this year, we recorded 1.7 million contracts traded for FCPO, which surpasses the previously held record last year, March 2020, which was 1.66 million contracts traded. And at the same time, on the other side, the options on crude palm oil futures or OCPO. So 2020 last year, between January and August, the OCPO recorded a total of about 45,000 contracts traded. So in that same period from January to August, this year in 2021, we can see that the volume has actually increased by 30%. So as of August 2021, there have been around 60,000 OCPO contracts traded. So as we can see, both our futures, crude palm oil futures, as well as the options contract is gaining traction around the world. Before I move on, I also want to mention that for the options on crude palm oil, we have recently rolled out our enhancements for the negotiated large trade system, or NLT for short. So this enhancement actually eases the trade registrations. So as OCPO is mainly traded via NLT today. So this enhancement that we have recently rolled out will certainly bring greater benefits for our OCPO and in terms of trading volume and helping our investors perform easier trade registration. Okay, so now we'll talk about the very, very exciting East Malaysia Crude Palm Oil Futures contract due to be launched next month. So a bit of background regarding this East Malaysian contract, or we call it FEPO for short. So for many, many years, there has been a long-standing desire for BMD to include East Malaysia ports into our existing FCPO contract. However, we did an assessment as well as industry consultation, and we found that by doing so, it would actually disrupt the current business because having too many delivery ports in one contract will pose a lot of challenges for buyers when it comes to taking delivery. This is because the FCPO contract, when it comes to physical delivery, it is at the seller's choice. So naturally, with more ports added into the contract, the buyers are at a greater disadvantage. Nonetheless, we recognize that the East Malaysian crude palm oil market has grown significantly over the years. It has developed from being a small contributor to Malaysia's overall production to now representing 45% of the country's CPO production. So as we can see here, the East Malaysian production of CPO compared to the Peninsular Malaysia production is almost on par now. So in this regard, BMD, we decided to launch FIPO as an entirely separate contract from FCPO. FIPO will have similar contract specifications with 3 exceptions: trading hours, delivery points, and speculative position limits. I will touch on these 3 shortly. Okay, rationale for launching. First and foremost, of course, we wanted to meet the needs of the East Malaysian CPO market. Engagements with our East Malaysian industry players, we found out that there is little trading of FCPO from them due to the absence of the East Malaysia delivery ports in FCPO. So FEPO will directly address these concerns and entice trading from these East Malaysian palm oil companies, allowing them to hedge their position in the physical CPO market. Secondly, we also hope to strengthen our palm complex offerings and provide price discovery. We hope through this contract will provide greater competitiveness and price discovery for the East Malaysian CPO market in particular, as well as in the long term, in the global context, we hope to affirm our position as the global price benchmark for CPO. And finally, of course, the other rationale for this contract is to tap into the Chinese market as part of our Greater China strategy. So we hope to strengthen the link between the Malaysian export and Chinese import market. In particular, with DCE's recent internationalization of their palm oil futures contract, we do see a lot of valuable opportunities for possible arbitrage between these contracts. A bit of overview of the CPO market in East Malaysia. So as mentioned earlier, the CPO production in East Malaysia has gone up significantly over the years. As you can see at the top left of this chart, in year 1995, Sabah and Sarawak only contributed approximately 22% of the entire country's total CPO production. When we move forward 20 over years, year 2020, we can see that East Malaysia has already contributed almost 50% of the country's total CPO production. So this is one statistic which, when we were doing our research, we felt we could not ignore. And then at the same time, when we talk about export of palm-related products in the last 10 years, we can see here in the chart at the top right that since 2013, the export of palm-related products by East Malaysia has actually surpassed that of Peninsular Malaysia. So the export activity in East Malaysia is definitely booming over the years, and the marketplace is getting more and more active. And finally, of course, the monthly crude palm oil spread price between Peninsular and East Malaysia. So between the years 2016 and 2020, the spread price between Peninsular and East Malaysia, you can see here on average, the difference is about 46 ringgit and 40 cents per metric ton. So key difference in contract specifications between FEPO and FCPO. So as mentioned earlier, firstly, trading hours. For the East Malaysian contract, the trading will start at 9 a.m. up to 12:30, and then the second session would run from 2:30 p.m. to 6 p.m. However, on the other hand, our FCPO currently begins at 10:30 a.m. to 12:30, and then the afternoon session is 2:30 to 6 p.m. as well. The second difference will be the ports of delivery. So instead of Port Klang, Pasir Gudang, and Butterworth, which we can see in the existing FCPO, the ports of delivery for the East Malaysian contract will be in Lahad Datu and Sandakan, which are both in Sabah. And then for Sarawak, we have Bintulu. And finally, the speculative position limits. So you can see here that the position limits for the spot month, all the other contract months combined, etc., it's actually half that of FCPO for East Malaysia crude palm oil. So 800 contracts for the spot month, 10,000 contracts for any one contract month except the spot month, and then 15,000 contracts for all months combined. So this is a snapshot of the main contract specifications for the East Malaysian contract. So again, so the contract code will be FEPO. This will be the short form name for the East Malaysian contract. The underlying instrument, the contract size, the minimum price fluctuations, and the contract months remain the same as that of FCPO. Then the first difference, as mentioned earlier, trading hours. The first trading session will begin at 9 a.m. The speculative position limits for FEPO will be half of the ones that are currently in the FCPO. Final trading day contract expires at noon on the 15th day of the delivery month. The tender period will be the 1st to the 20th calendar day of the spot month. And the contract grade and delivery points, of course, again, the delivery ports will be in Bintulu, Sandakan, and Lahad Datu. And the contract grade of the CPO will be the same as that of FCPO. So free fatty acids, less than 4% in tank, less than 5% out tank. The M&I values, less than 0.25% in and out tank. And the Dobie value, more than 2.5% in tank and more than 2.31% out tank. So again, to re-emphasize, the contract grade remains the same for FIPO and FCPO. Okay, so a bit on the tender process. By tender process, we refer to the physical delivery flow. So when a seller wishes to deliver physical crude palm oil, he will do so together with this set of documents called the traceability documents. So what the traceability documents encompass is it will contain information regarding the company of the seller, the mail party address coordinates, the amount of CPO that the seller wishes to deliver, as well as the MSPO certification number. So MSPO stands for Malaysia Sustainable Palm Oil. So the MSPO certification is an initiative that was started by the government, and the government basically wants or rather wishes for all delivery of crude palm oil to be certified MSPO, meaning they are certified sustainable. So Bursa, we have affirmed this stance towards sustainability, and we have actually implemented this MSPO certification requirement for all physical delivery in the existing FCPO, as well as the upcoming FEPO. So when the seller delivers the oil, he will have to deliver these traceability documents, which will basically have the information regarding where the source of the oil come from and whether it has adhered to the MSPO requirements. So he will deliver all of this, the oil and the documents, to the PTIs. The PTIs will then check that the quantity of CPO delivered is correct, the contract grade of the oil is correct, the oil is MSPO certified. And once all the documents and information are in order, the PTI will then issue this ENSR, electronic negotiable storage receipt, if all requirements are fulfilled. So once the PTI issues this ENSR, the seller will then notify his clearing broker on their intent to tender. The seller's clearing broker will then notify the clearing house, which is the exchange, and the clearing house will then allocate the CPO to the buyer's clearing broker. So this is for seller. Moving on to the buyer. So once the clearinghouse allocates the tender to the buyer will have to make full payment to his broker. After that, the broker will make the payment to the clearinghouse. The clearinghouse will then provide the ENSR to the buyer's broker, and then the buyer can then proceed to collect the oil from the PTI that was allocated to him. And upon collection, the PTI will of course provide the traceability documents of the oil which the seller had provided originally. So this physical delivery flow for the East Malaysian CPO contract is exactly the same as that of FCPO for those who are familiar. So the physical delivery mechanism remains the same. Okay, so port tank installations, we can see here for the East Malaysian contract, we will have PTIs located in Lahad Datu, Sandakan, and Bintulu, where at the same time for FCPO, we have about 20 PTIs in Port Klang, Pasir Gudang, and Butterworth. Who will be the potential users of this contract? So firstly, of course, the East Malaysian palm oil refineries and importers. Demand for the East Malaysian CPO is mainly from the downstream players and the importing consuming countries like India. So with most refineries not currently trading FCPO, they are unable to manage their raw material price risk for CPO. So we hope through this contract, they are able to meet their hedging needs. At the same time, we also hope to target the East Malaysian plantation and millers. So with the ports designated in East Malaysia, these plantation companies and millers can hedge their production much more effectively by delivering their oil to the designated ports in East Malaysia. And of course, the final group will be the commodities desks as well as the arbitrages. So again, as mentioned earlier, there are arbitrage opportunities with FCPO due to the price difference between CPO from Peninsular Malaysia and East Malaysia. And then at the same time, again, DC internationalized their palm oil contract. So the internationalization of their contract presents valuable arbitraging opportunities with their contract. So these are a few key reasons why you should trade or consider trading our palm complex. So first and foremost, of course, our products, FCPO and FEPO, will be traded electronically on CME Globex. CME Globex is the electronic trading platform that BMD uses currently. The CME Globex provides global access and global reach and connectivity to clients all over the world, and it will allow individuals and professional traders anywhere around the world to access all of BMD's products. And then, of course, at the same time, through our palm complex, investors can properly discharge their risk management functions. They can partake in leverage trading. For many global fund managers and commodity trading advisors and prop traders who want to gain immediate exposure, they can do so to the active crude palm oil market via our BMD palm complex. And of course, at the same time, by trading on BMD, investors can trade with confidence in a secure and transparent marketplace, which is regulated by the Securities Commission. Okay, so for the new contract, these are the ticker codes for Bloomberg as well as Refinitiv. For all the attendees who are interested, you can take a quick picture of this. Yeah. And of course, please scan the QR code to go to the FCPO landing page, and definitely reach out to any of the licensed futures brokers to get started. Visit the website www.bursa.malaysia.com. As you can see at the screenshot at the bottom, you can click on those links to contact one of the licensed futures brokers to open a futures trading account. So this concludes my presentation today. I hope many of you found it informative. Thank you. Back to you, Mengna.
Thank you, Nicholas, for the very comprehensive introduction of BMD CPO products. For audience who have any questions, please message us in the chat box. Nicholas will address your questions at the end Q&A session. Okay, now, thank you, Nicholas. Now let's welcome our second speaker, Patrick. Patrick will give us a talk on designing a hedge program and hedging using CPO futures contract. Okay, can see your screen now, Patrick.
Okay. Well, thank you. Thank you, Mengna, for organizing this webinar, and thank you for all the participants. You are the most important. That is why we had this webinar for you. All right. I know that many of you are, you already know me. You probably from the rubber market or from my colleagues from Indonesia. I saw many of you sign on. Thank you very much. And those customers who actually invited by me, who actually on this webinar, I just want to say thank you very much also for coming to listen to this webinar. All right. Today I actually give you a very nice program, and these are the agenda that I put on this afternoon. Yeah. So let me set my timer so that I don't overshot. Yeah. Because the problem with me is that once I start talking, sometimes I don't stop, you know. Yeah, some of you know me. Yeah, so today my task is basically to tell you about hedging. The word hedging is actually very commonly used in futures market, financial market, commodities market, but not many people actually understand the meaning. So my task is to explain what is hedging and why is hedging important, especially those of you who are out there handling what we call the fiscal or spot market or fiscal market. All right. Point number 2 will be designing a hedge program. Few points to note. This hedge program actually is important for you, even if you are trading rubber or metals or gold or currency. It's good for you to know how to design a hedge program. All right. Then I'll give an example of a producer's hedge using the Bursa Malaysia CPO futures. All right, and also a consumer hedge. Then finally, I'll finish off with what are the costs and concerns about hedging. All right. But before I actually start, I also have a disclaimer that whatever I speak, myself and Straits Financial is not liable for anything that is inaccurate, or if you omit anything, you can always tell us, okay? And you can email me at the bottom here, patrick@straitsfinancial.com. All right, if you have any questions. So let's go to the proper thing right now. And what is hedging actually? A lot of people think that hedging is a sure win thing. Some people said, oh, hedging is expensive. We don't have that money to hedge. Some people think that hedging is speculation. So there's a lot of misconception in the word hedging. But today I want to explain to you that hedging is basically a transferring of price risk. All right, because the market goes up and down every day. And sometimes we are not sure whether it goes up or goes down. Like today, for example, right now, the palm oil in Malaysia just dropped 100 ringgit. It's volatile, you know. So to transfer this price, just imagine if you are holding some inventories, okay, in your tank or whatever, you know, in your factory or whatever, and suddenly the price drop. All right. So it will affect actually your bottom line, your P&L. All right. So in order to transfer this price risk, you go to the futures market and you do what we call hedging, all right, to transfer your price risk. So hedging is basically a process by which you take an opposite and, if possible, an equal position in the futures market to offset this potential loss due to price fluctuation, okay? Potential loss of your fiscal, all right? So hedgers are people who are risk averse, unlike the speculator who actually take risk to trade and earn trading profits. All right. So hedgers are different. Hedgers basically wants to averse the risk, to remove the risk. All right. So when you are long a hedge means you're long futures. All right. You are short the physical. And when you short a hedge means you sell futures to hedge against your physical goods. All right. But why is hedging important? Especially so to those people who deal in the physical market, whether you are a producer, whether you are a milling company, whether you are an exporter, whether you are a consumer. Hedging is basically to reduce price uncertainty. All right. Like I mentioned to you, we are not sure whether the price will go up or down. Nobody is sure. So we want to take upon a hedge to reduce this risk. And hedging point number 2 here protects profit margin. If you know that if you sell in the futures market now, you can make 10%, 15%, all right? Rather than losing this 10, 15%, 20% of your profit margin, all right? Or even if you are suffering a loss, it actually reduces your loss deterioration. Hedging allows flexibility in pricing your cash commodities, okay? And also determine your P&L and your costs. In other words, once you hedge, you know how much you make, how much you lose, how much is your cost. You can sleep well at night, basically, all right? If you do your hedging. If not, every day you're worrying about, I don't know what is the palm oil price tomorrow, or what is the rubber price tomorrow, going up or down. And some of you are still praying, you know, something like that, all right? Yeah. Okay, point number 4 is credit control and financing make easier. This is very true. If you hedge, and if you go to the bank and say that, hey, I need to borrow another $2 million because I want to expand another line, another factory line, or I want to build another milling company, milling factory. All right, the bank will say, why should I lend to you? You say, hey, look, I hedge my position. I know how to manage my price risk. Please lend me money. Oh, it's quite good. You know risk management. You know how to do hedging. Okay. I'm not saying that the bank will automatically lend you the $2 million. No, I'm saying that the bank will still assess, but your chances of getting bank financing is made easier. All right. And of course, point number 5 is you're closer to international markets and monitoring of price risk and flow. This one is actually debatable because some fiscal people also monitor the international market very closely. Like, for example, the stock level, you want to know how's the weather pattern in the Midwest. You become more what we call true to international events. Okay, what happened to the Fed action? All this can actually impact. What are the export figure, for example? So these are important factors that you begin to look more closely, and that's important for you. Okay, now we go to designing a hedge program. You will see this slide, there's a little red star here. And this red star is actually, in other words, important slide. Always put a star there when there's an important slide. The first thing first is when you design a hedge program, okay, whether it's for palm oil, whether it's for gold, whether it's for rubber contract, you need to choose a futures contract to hedge because you are dealing in the physical market. All right. So of course we choose Bursa Malaysia, okay, because they have the best CPO contract in the world. All right. Although it's priced in Malaysian ringgit, the liquidity, the number of years that they have been launching this contract is more than 40 over years already. All right. So Bursa Malaysia contract will be something ideal for you to do hedging. All right. Second point is you must know the contract size. And we know that the Bursa Malaysia contract size is 25 metric tons. All right. So the contract specs, like for example, the delivery point, the last trading day, this is something that you need to know. Not only know it well. You don't hold a contract until the contract expires, then you say, hey, have to take delivery. Then after that, you karang kabut and say, oh, die lah. You know, I have to go and collect, 1,000 tons of oil. Where should I put my oil and all that? All right. So 25 metric tons is something important. And the third point, very important, another star here is the hedge ratio. The hedge ratio is the number of contracts that you need to hedge in the futures market. For example, you have 100 metric tons to hedge. In palm oil, 100 tons is very little. So 100 tons divided by 25 is 4 contracts. All right. What happens if you have 1,000 tons to hedge? 1,000 tons divided by 25, you have 40 lots to hedge. All right. The hedge ratio is something very important. All right. The fourth point, equally important, is actually the period or the time of hedging. Okay, if you have sold something 3 months forward, then you want to hedge. Make sure that your hedge cover the 3 months. Because from now until any time 3 months, if the prices goes up and down, there will be P&L swing. Okay, so if you have sold forward or if you have to hedge 3 months, you don't get into 2 months because you hedge. All right, because the last month you're exposed, you're naked on your position. All right, and of course whether you are long hedge or short hedge. Okay. This is whether you're long futures, you should buy futures or you should sell futures. If you have a lot of inventory, then you should sell futures. We call it a short hedge. But if you have a lot of palm oil, physical palm oil, and yet you can buy futures, then susah lah, you will be long physical and long futures, okay, which is wrong. It's not a hedge. Huh? Yeah. And of course, the last point is that you must have an account with a futures broker. And that's where Straits Financial come in. Huh? You're welcome, for those of you who have not have an account, you're welcome to open an account with Straits Financial, either through me or to any of the colleagues. It's fine. All right. And in opening an account, of course, there will be documentation. Huh? Documentation, whether it's an individual account or a corporate account, you need to fill up some forms. You need to put an initial margin as well, huh? Which is a good faith deposit to support your position. All right. So let's say, for example, you will trade 1,000 tons, and 1,000 tons is, for example, 40 lots. All right. And one lot of palm oil, let's say, is, for example, 7,000 ringgit. Yeah. So 40 lots times 7,000, you get 28,000 ringgit you need to deposit. All right. Okay, let's go through the hedging proper. Time is running out because I'm only given 15 to 20 minutes. Okay, so we are going to hedge what we call a inventory, or if you have stock, your freight prices go down. All right. So let's go through this very quickly. A palm oil processor, all right? If you are, you buy the FFB, you have 2,000 tons of palm oil, and already processed. Maybe you put inside your palm oil tank or something like that, and you're waiting for the buyer. All right. And meantime, the owner of the CPO, the processor, is afraid that prices will fall in the next couple of months. I just saw the palm oil price just now, it dropped 100 ringgit, Morning was okay, suddenly the price came down. And the prices of Malaysia, third month is usually the most active month. November contract is trading at 4,355. Huh? When I was preparing this slide, today is Friday, I think on Tuesday, yeah, it's about 4,355. So the processor decided to hedge 50%, half of an inventory. He has 2,000 tons, so he's going to hedge 1,000 metric tons. I mean, you are the boss, you're the owner, you can hedge 100%, you can hedge 50%, you can hedge 20%. It's your hedge program that you decide to hedge 50%, all right, of your inventory. So we calculate, the first thing is we calculate the hedge ratio, how many lots to hedge. And here we have 1,000 tons divided by 25, you got 40 lots to hedge in the futures market, all right? So you have to sell, today is the 10th of September, right? Okay, to make it easier today, you sell 40 lots at 4,355, the futures price here, all right? Cash, you're still holding 2,000 metric tons, all right? And you short, okay? Let's go through the hedge program again. Number one, you choose Bursa Malaysia, right? The futures contract. Number two, you know that the contract size is 25 metric tons. Okay, the hedge ratio. All right. And number three, you hedge the third month because you don't know when the buyer is going to appear. Maybe next week, maybe next month. Okay, but you hedge third month because it's the most liquid month currently. All right. Let us see what happened. All right. 2 weeks later, on the 24th of September, the price actually fell to 4,100. Okay. Actually, the price can fall in one day. Sometimes $200-300 movement is quite common actually. All right. So the customer suddenly came and said, I want to buy 1,000 metric tons at 4,100. A physical customer come to the processor and say, I booked 1,000 tons from you. And the processor say, fine, I can sell you 1,000 tons at the current price, 4,100. All right, in the physical market. So what happened is that the processor also unwind his hedge. Okay. He actually sold 40 lots at 4,355. 2 weeks later, when the processor buy back 40 lots at 4,100, actually he make a gain of 255 per ton. All right. But in the cash market, he still hold 1,000 tons. If you have hedged 2,000 tons, would be great, right? But anyway, he chose to hedge 1,000 tons. So he sold 1,000 tons to the buyer. All right. So his hedge gain is 255 multiplied by 1,000 tons, 25 tons times 40 lots. Yeah, the hedge gain 255,000 ringgit. All right, is this a sure gain or guaranteed profit? This is actually the hedge gain, because if he didn't hedge, he would have sold lower without any extra money. All right, so he's actually the 1,000 effective price is at 4,355. All right, so please note, the gain on the futures hedging is offset by the lower price is sold in the physical market. So is it sure that guarantee profit? No, hedging is to transfer the price risk. And in this case, what happens if the futures market go up? Then he will lose in the futures market and cash market. He will sell at a higher price. Okay, next hedging, we're going to talk about the consumer hedge. All right. Not to worry, for those of you who listen until blah, blah, or not sure what is it, you can always send me an email, all right? We can discuss. Okay, a consumer hedge means he needs the palm oil. He buys the palm oil. He's afraid of rising prices. Okay, in this case, a buyer from India, and we know that India is the largest consumer of edible oil, all right? And they buy a lot of palm oil actually from Indonesia now, especially because of some quarrel between the government, somehow something like that. Yeah, a buyer from India buys an average of 1,000 metric tons of crude palm oil every month. All right, from the seller. This seller can be Indonesian seller, it can be a Malaysian seller, it doesn't matter. All right, to be delivered at the end of each month, November, December, and January. So every month he wants to buy and take delivery at the end of each month. And the buyer expects the palm oil price to go up in the next 3 to 6 months. Okay, the buyer is afraid that prices will go up, he will be buying higher. All right, but he don't need the palm oil now. He need only at the end of November, December, and January. All right, so he expects prices to go up due to higher demand in India, maybe. That's the reason. That could be the reason. Also lower production. There could be a drop in the Midwest. You know, the last few months in the US, we saw soybean oil prices has been rallying due to the drought there. There's an immense drought, you know, in Illinois, in Iowa, in Missouri. Yeah, and the prices went rocket high. All right. Tell me I only have 5 more minutes. All right. And the drought, so soybean price could be higher. Okay. So crude oil prices on the Malaysian rubber exchange is, these are the different months. I want you to look at the prices carefully. You can see that October 4458, November, December. You notice that the further the month, the cheaper it is. This shows one thing. This shows that it is a backwardation market or discount market. All right. If the word backwardation is too big for you, it is a discount market, meaning the demand for the front month is higher, okay, or not enough palm oil right now. So the spot month or the near months are trading at a huge premium. All right. But anyway, fearing higher prices, he need to hedge. The Indian buyer need to hedge 1,000 metric tons in November, December, and January. So how does he hedge? Okay. You go and buy lah, huh? We call it a strip hedging. Huh? When you hedge November, December, January, the various months, we call it a strip hedging. So he bought 40 lots, 1,000 metric tons is 40 lots. He bought 40 lots, 4355, bought another 40 lots, 1,000 tons for December at 4272, and he bought 4195. All right. So what happened is that a few weeks later, before the expiration, you see this guy, he doesn't want to take delivery. Okay, he just wants to protect his price risk. So when come to 15, he probably bought 1,000 from a trader or whatever in the future, in the spot market, and he said deliver end of November. So what happened is that he lift his hedge. Lift the hedge means he unhedged his position. So he bought at 4355. The market actually went up 4445 on the 15th. That is the day where he actually unhedged. Okay, so maybe he sold to the buyer some physical goods. He make 90 ringgit per ton. All right, then come again the next month in November, he unhedged again, but this time the price dropped to 4250. He lost 22 ringgit per ton. All right, so you can see that the first hedge, 90, he make 90,000 ringgit on the hedge. On the second month, he actually lost 22,000. All right. And on the third month, on the 2nd of December, he hedged the January contract. He unhedged at 4225, he made 30. So you can see that not every time the hedging makes money. This example is to show you that when you do a hedge, it's not a guaranteed profit. Some hedge can make money, some hedge lose money. But what is important is that whatever you make in the futures market, you lost in the spot market because you will have to sell lower. All right. But at least there's a lock-in for you, and that is important. All right. Cost and concern of hedging. All right. So in hedging, on one side is offset by losses another. I just mentioned to you, if you have profit in your futures market, likelihood is that your spot market you sell at the worst price. All right. Basis risk, because the futures price and the cash price doesn't move exactly the same. Sometimes the futures price goes up 50 ringgit, maybe cash price go up only 40 ringgit. All right. So there is what we call a basis risk that exists. And this basis risk you need to monitor. All right. Currency risk. All right. The CPO contract on Bursa Malaysia is traded in ringgit. So when you sell your hedge, if you get a profit, it's in ringgit. All right. So if the ringgit actually drop in value, then your profit get affected. Your hedge get affected because of the currency risk exposure. All right. So when you hedge, especially big amount, your currency risk you also need to hedge. And you know what's the beautiful thing? At Straits Financial, we got an FX desk for you to hedge. You don't have to open additional account. All right. You probably need to sign one form and say that I need to hedge my currency risk. All right. And match risk is the number of the tenor period. All right. I mentioned just now, if you need to hedge 3 months, don't hedge 2 months. All right. That is called unmatched risk. Make sure that you cover 3 months or 4 months. All right. Minimum variance hedge versus optimal hedge. Okay. Minimum variance hedge means if you need to hedge 1,000 tons, it's 40 lots, right? We know this is what we call minimum variance hedge. But if you think that the market is going up a bit more, you hedge, let's say 45 lots, you add another 5 lots. And these 5 lots is in perception that the market is going up. You're quite sure and you want to, I won't call it speculate, but you want to add on to reduce your, because you have to pay margins and all that, right? So you add on a few more lots to optimize your hedge, which is actually not advisable. Huh? We call it the optimum hedge. All right. Some people hedge. After that, it turns speculation. Huh? Many of you are like that, I know. But I don't blame you. Huh? And finally, the cost of hedging. All right. This includes the initial margin. Variable margin means when you have a futures exposure, you are subject to mark-to-market valuation, and you will have a margin call if the prices go against you temporarily. All right. So you must have set aside some money to top up the margin. All right. If not, the futures broker can liquidate all or part of your position. All right. A commission fees to your broker. Of course, this is something that they provide a service to you. They send statement to you every day, faithfully. They service you every day. You pay them a small commission fee. All right. And of course, the platform and data fee for those traders who trade themselves. Sometimes you need to have the data fees that pay to the vendors. Huh? So in conclusion, just show you the graph of the palm oil price. It has gone through the roof from the year 2000, April, all the way up to 2005 and 20, I think. All right. What is interesting is that the market is now very high. Is the market going higher or lower? Okay, my topic is only on hedging, but I just want to show you that prices has gone up in the last 5 years. All right. And you can see a top here and a top here. All right. And a 3 bottom here. Okay. Very beautiful bottom around 1,900. And you can see that actually we call it a triple bottom here. And the price actually sprang up after breaking the top here. And what is interesting is that we have a double top now at 4,500, I think 20. All right. And is prices still going up or coming down? It's not in part of the agenda today. All right. You decide. All right. So with that, I thank you very much. That's my end of my presentation. I hope you learned something today. I hope you know how to design a hedge program. And for those participants who are here, thank you very much for tuning in. Back to you, Minna.
Thank you, Patrick. Thank you very much for your informative presentation and providing examples of hedging using CPO futures. Again, for all the questions directed at this presentation, Patrick will address them at the final Q&A session. Then let's invite Zach to give us the last talk today on hedging CPO using options and examples of hedging solutions for producers and consumers. Welcome, Zach.
Hi everyone. So I believe everyone has got a very insightful class from my colleague Patrick over here. So next I'll talk about how you can use options as another hedging tool for your hedging strategy. Right. A quick disclaimer over here. Okay, the benefits of using options. So earlier on, Patrick has actually presented to you the use of futures. So what's the difference between options? So options allows you to have protection of the price movement, okay? But at the same time, apart from, unlike futures, where it actually mitigates the entire price risk, options allow you to have additional upside gains if price moves in favor to you. Okay. Second, flexible risk management. Now, through all hedging solutions, there is always hedging strategies. There will always be a time frame. So options, let's say for example, you execute on day one, and as you go by and prices might move against or in favor of yours. So you would then want to also add in additional option contract that might tweak your hedging strategies to optimize the ultimate hedging goal. Lastly, options. So when you sell a particular option, you can actually receive premium. So these short options, when carefully executed, these additional premiums that you collect can actually help to provide cost savings to your inventory. Okay. So next, I'll be giving you an example of what a palm oil producer can use by using options for their hedging. Okay, quick example. On 15 July, past example, on 15 July, a producer was expecting a delivery of 1,000 metric ton of palm oil in September. That's about 2 months' time. So with a production cost of 3,000 ringgit per metric ton, the producer would like to get a price protection at 4,100 per metric ton and to protect his minimum sale price. Okay. So looking at the chart over here, on 15th of July, the prices was hovering around 4,200. So it was at about 4,230. So and producer thinks that he had the view that prices might continue to go up, but he do not want to risk it. So he actually think, okay, what about I would then execute an option? Okay. So the option that he can do is actually to buy a put option. Okay. So he would then execute and buy a long put option at 4,100 ringgit with an expiry at September, which is his delivery month. Okay, and by executing this option contract, he would then have to pay a premium of 170 ringgit. So this is a cost to him and a cost of his hedging. Okay, now at this point in time, perhaps some of the producers might actually think that, okay, look, this premium that I need to pay might be quite costly to my eventual cargo cost. So he was thinking, he calculated that, maybe I'm willing to sell my prices at max at 4,500 ringgit per metric ton for his palm oil. So with that in mind, he thought, why not I could sell an option, okay, and to collect some premium to lower my overall hedging cost. What he did over here is then he sold a call option. So he went to the market, he short the call option at 4,500 ringgit per metric ton. So same delivery month, okay, and this time round he received a total of 130 ringgit per metric ton. Okay, so this collection of premiums actually helped to lower his overall hedging cost to only 40 ringgit per metric ton. Okay, to bring you into the example itself, I prepared here of people. So similarly for that same producer, if from July, if he would not have entered into any hedging, okay, not even futures or any options, this will be his P&L, depending on the prices that market falls in September. So let's say, for example, at a lower price end of about 3,600 ringgit, he would have made a total of only about 600,000 ringgit okay, or as an overall P&L, and it goes up as the price moves up. Okay, so what happens when he executes his hedge strategy through options? Right. So over here on the right is actually an options hedge payoff. So basically, what you the P&L that you will eventually be having when you executed the earlier strategy that I explained. So back then in July, he would have then executed a long put option that protected his price level at 4,100 ringgit. Okay, so if you look here at 4,100 ringgit, his price actually protected. So anything that falls below that, he doesn't have to worry about that because the option would have paid him the additional amount and kept his overall P&L to 1.06 million ringgit. Okay, and subsequently, to lower his cost, he also sold a call option. So he sold a call option at 4,500 ringgit, and this would actually cap his sale price at 4,500 similarly, and would have then, in addition, earlier on, he had paid a 40 ringgit per metric ton for his hedge cost. So eventually, if prices move way above 4,500, he would then have to cap his total overall P&L at 1.46 million ringgit. Okay, so I think with reference to what the prices were today, we were falling right below 4,400. This option payoff would actually deliver him the prices between this level, between 1.1 to 1.3 million ringgit. Okay, so next, due to time constraint, I will not cover solutions on consumers. So feel free to always write to us and we can speak with you more and see how we can help. To conclude this presentation, I would like to also, explain to you guys a key comparison between futures hedging and options hedging and what could be used in different situations. So the first key difference would be price participation. Earlier on, as I mentioned, futures would actually eliminate total upside and downside risk of yours, while on the other hand, options can actually give you price protection, while at the same time, it gives you unlimited upside gains if prices move in favor of yours. And the cost of hedging. For futures, what you need to pay is actually all the broker's commission and your clearing fees and all. So on the other side, options, because of the advantage that you gain, you would then have to pay a certain form of premium. But as mentioned earlier on, you could also tweak the strategy to actually give you some savings over the cost. Okay. Next will be the margin requirement. So as what BMD has stated, the margin requirements of the CPO futures contract is about 7,000 ringgit. But say, for example, if you go to an options hedging, okay, and what the exchange also require in terms of margin requirement of options is also slightly lower. Okay, so when is the best time to use either options or futures? So if you do feel that there is a market uncertainty, you don't know whether price will go up or down, you do not have a view of it, it is also still best that you actually hedge off the entire price range of it. So use futures to hedge that off. So of course, if the producer or consumer do have a view on palm oil prices, like you're going to short up or even go fall crash down. So probably he might want to use options hedging to actually gain additional upside when the price moves in his favor. Okay, so that's all for now, and we can have many different kind of strategies through these different options and futures. So always feel free to reach out to us, and you can reach us through our email, and we will be happy to answer your questions. Okay,
Okay, thank you, Zach, for your very informative presentation. I believe the examples you provided would be very much useful for investors to understand CPO options. Okay, now let's proceed to the Q&A session. Seems we don't have time for all the questions. We will just select some questions for you to answer. Is that okay? So the first question is for Nicholas. The question goes like this: what is the status for PTI onboarding? Nicholas, can you help address this question?
Hi, yes, thanks for the question. So for the upcoming East Malaysian crude palm oil futures contract, we have already onboarded 3 PTIs. So one in each location, one in Sandakan, one in Lahad Datu, one in Bintulu. And at the same time, we are working on the onboarding process for 7 other potential PTIs. So all in all, we hope to have 10 PTIs for our new East Malaysian contract. In comparison, our FCPO has currently around 20 PDIs, if I'm not wrong. So the fact that there are potentially going to be 10 PDIs for this new contract is a really, really encouraging development for us. Yep.
Okay, thank you, Nicholas. I hope Nicholas have answered your question. And next one is for Patrick. Is leverage allowed in futures trading? Patrick, can you help answer this question?
Okay, thanks again for the question. Futures market, basically it's different from the share market, all right? You put what we call a deposit, an initial margin. And this initial margin generally is about 5 to 10% of the actual contract value. So because of that, in other words, you pay $10 to trade something $100. This is what we call leverage, all right? So in CPO futures market, yes, in fact, in all futures market, that is why futures market is deemed as risky and dangerous. Some people say it's gambling, but I don't think so. I think it is leverage trading. So to answer your question, yes, CPO leverage trading is allowed, all right? And the initial margin right now is about 7,000 ringgit for one contract, 25 metric tons. It's about 6.5%. So you put 6.5% to buy something 100%, all right?
Okay, thank you, Patrick. And next one, we have a question for Zach. Where can I trade CPO options, and are they traded electronically?
Okay, so for CPO options, it is not very liquid on the electronic market. But so what most players do for CPO options is that they go through your major brokers like the Inga, your Star Supply Community, OTCX. And these option contracts actually go through this system called negotiated large trade, right? And there is a minimum size of about 50 lots per contract. So yes, feel free to always reach out to us or actually to your brokers to get this option contract.
Okay, thank you, Zach. Thank you very much. So it seems that we don't have so much time. I would like to thank all our guests for joining and for your valuable input. And also thank all the audience for listening. Hope this webinar is useful to you. If you have any questions, comments, or need further discussion on your hedging solutions, please contact us by the contact information on the screen. Thank you all again, and hope you have a great weekend ahead. See you next time. See you.